Think Realty Nation, it's Abhi Golhar. Welcome to the Think Realty podcast. In this show, you're going to learn about self-storage and why self-storage should be on the top of your list of investment strategies. You have a lot, right? You can wholesale single family, buy single family rentals, fix and flip single family, buy land, do commercial, multifamily syndication. The list goes on, right? Like it's like a dot, except the dot, you can copy and paste for like 10 minutes because that's how many exit strategies and opportunities there are in real estate. Well, maybe consider self-storage. So before we get into that conversation, I want to make sure that I give a huge shout out to the podcast sponsor for today, who is my good friend Aaron Chapman. He's written a bunch of books, and you know him because he has the longest beard in the history of mankind for males. Aaron Chapman. So, podcast is brought to you by Aaron Chapman, AaronBChapman.com. Bypass all of the overcomplications of the common suit and tie mortgage guy and connect with Aaron Chapman and his team of real estate investment finance expert at Security National Mortgage. You get no fluff and no complicated industry speak, just brutally direct action. Visit AaronBChapman.com today for more information. That's AaronBChapman.com. All right, so my guest today is Fernando with the Titan Wealth Group. And we're going to talk about self-storage after Fernando's interview. We're going to talk a little bit about, there's a very interesting article on Real Estate Investing Today, which reveals that 84% of people believe that you should rent more than you should own. And what's funny about this entire conversation is when we had Think Realty Radio, we were talking about that a year and a half ago. We were talking about the benefits of renting versus owning and how you can now rent the American dream versus own the American dream. So, I don't know. I might do a little bit of rant on that. We don't know yet. You're going to have to find out. Let's go to Fernando. Fernando, welcome to the show, man. How are you doing?
I'm doing well. How you doing?
Good. So, you told me how you pronounce your last name before the show, and then I kind of forgot it. I forgot what you said. So that's like my bad. But it's Angelucci?
Angelucci.
Angelucci. Right. All right, cool. And we were thinking about doing something epic. So I don't know. We'll have to figure that out. It's like Fernando is on with. That's great. I think that's awesome. All right. So give us a little background. Who are you? What you do? Obviously, we're talking about self-storage, but give me a little extra background and bio.
Yeah. So I grew up the son of two immigrant parents. They kind of beat into me that got to go for the American dream, study, go to school, get a good job, and stay there for 40 years, retire with a pension. Obviously, that's not the way that things work anymore. So I immediately jumped into my real estate career when I was 23 years old. Quit my 9-to-5 working at a Fortune 50 company and started doing single family wholesale, then flipping properties, then buying rental single family as well as rental multifamily. And this dream that I have had of this passive income turned out to not be so passive after all. Even though I had a property manager for all my facilities, I was still having to spend a lot of time managing the property managers, putting out fires, and that's not really what I wanted to build for myself. So about 3-4 years ago, I started really looking at self-storage, and it kind of answered all of those questions I had and those concerns. No toilets, no tenants, no trash. It truly was passive. And then one of the biggest issues that I was facing, because I'm in the Chicago market, our tenant landlord laws are very strict against landlords. I had an eviction that was going on its 8th month, and that tenant ended up causing almost $25,000 worth of damage in my one unit. And that's when I really decided, I'm done with this. Sold all of my multifamily, sold all of my single family, and then started trading up into self-storage.
So that's a very interesting strategy, right? And I think there are a lot of investors out there too that are like, wait, I know there's more in the real estate space, and I've heard of self-storage. It kind of seems like it's an elusive asset class or within real estate, and it's a different type, obviously, but they don't really know how to feel about it or how to reconcile what to do first. So there's a lot that we're going to cover here, but let me just ask you, kind of point blank. Why does self-storage win above the other types of real estate that you can invest in?
Yeah, so there's a couple of reasons that I really like it over everything else. Number one, it has the highest returns historically compared to any other real estate asset class. When you look at, let's say, 1994 to 2017, self-storage returned on average about 17.43% per year. Multifamily, on the other hand, returned 13%. So that 4% doesn't seem like a lot, but you got to realize that's 4% compounding. So if you invested $100,000 in 1994 into, let's say, the S&P 500, apartment buildings, and self-storage, by 2017, the values would be as such. S&P 500 would be about $500,000. Apartment buildings would be about 1.7 million, and self-storage would be about 4 million. So almost double, or a little over double your return on that asset class. The other thing that I really like is there's no evictions in self-storage, because this is not a habitation. You're not allowing people to live there. What you're doing is allowing people to store their stuff, and in return, you're allowed to place a lien on their stuff if they don't pay. So if they don't pay, instead of going through the entire arduous eviction process, what happens is we just overlock their unit, and then we put a auction notice into the local legal newspaper. And within 30 to 45 days, someone buys their unit, cleans out, broom sweeps their unit, and then we're already re-renting to the next tenant.
That's pretty spectacular. That beats a lot of eviction processes. And like you said, then you have to still deal with humans, and right, and that's, if you want to get away from humans altogether, self-storage is probably for you. And
another thing I was looking at too is, look at the environment we're in today. With the whole COVID thing really affecting the economy, self-storage has a fantastic track record in, operating during recessions. So let's look at the most recent recession, which was 2007 to 2009.
Okay.
During that period of time, the S&P lost 22% of its value. Mortgages dropped about 20%. Multifamily from a REIT grade perspective and single family from a REIT grade perspective dropped about 7%. Self-storage only dropped about 3.5%. So again, compounding over time, that's people usually think, okay, if it's got a high return, that must mean that it's also a very risky asset class. And that is not the case. And then if we dive deeper into that and you look at the type of leverage that's available to us versus, let's say, multifamily or single family loans, the banks love this asset class. Not only does it have the lowest default rate across any real estate asset class, but in the rare chance that it does default, it also has the lowest loss to the bank per default. So for that reason, that's the reason we're getting so many great leverage offers from banks. We just closed on I think it was about an $800,000 self-storage facility. We got 100% financing from a bank, and the rate was at 5% interest. We're about to do a $12 million ground up development in the suburbs of Chicago. The bank is offering us a 75% loan to cost at 4% interest. You don't usually see these types of rates and terms in the multifamily or single family space.
It's interesting. I was just having a conversation with a lender, and the two words that came up on a very regular basis in that interview and that conversation was consistency. Mm-hmm. And that's really, really important, right? Like, you want to make sure that those returns are going to be there every single month and every single year. And I think the other component with all of this is the confidence. Right. And what's happened with Wall Street is, where is that, right? Like, where's that confidence gone? And right. It's not there as much as it was. And so when we talk about lending and flippers and wholesalers, and because wholesalers are just part of they're just part of the food chain, right? Like, wholesalers can't sell their stuff if flippers can't get the right financing to buy the stuff that the wholesalers have to sell. So maybe it makes sense to start taking a look at self-storage, right? You mentioned COVID-19 has drastically impacted economies around the world, and devastated economies around the world, and small businesses across America, which are going to be, let's face it, right? Like, small businesses make America America. Right. So we have to be now that much smarter with our money moving forward to create these investment hedges so that we're not as affected, because we've been playing it safe. And how much has the S&P lost over the last 2 months because of COVID? Man. You probably know. I don't know the exact number, but it's been a lot.
Yeah. So you touch on a few things that I'd like to expand upon. So
Go for it, yeah.
self-storage is just the vehicle. It's not the strategy. So the strategy, we can wholesale self-storage. I closed a self-storage wholesale deal about 4 weeks ago. And we walked away from the closing table with a $232,000 assignment fee.
Awesome.
So that's an option. That only took 45 days. So a little bit longer than a traditional single family wholesale. And it didn't take much additional work on the due diligence. You can flip self-storage. We're doing that right now with a facility in North Carolina. We just bought it. We're going to turn around the management and we're going to relist it again in about 12 months. And then obviously the things that I really prefer is the cash flow. The cash flow that comes from self-storage is fantastic. Right now, our day one acquisition cap rates across our portfolio is at 9.7%.
Nice.
When you look at, let's say, the multifamily space, it's so compressed right now. It's hard to get anything decent, quality location, quality product for, higher than a 6% cap rate.
Right. One of my friends, he, in the height of the multifamily craze, I remember there was a very specific point in time, like 2.5 years ago, where everybody was starting to invest in multifamily and everybody had a fund and everybody was doing it. And he ended up purchasing, I can't remember what the unit size was on the multifamily deal that he did, but it was near the airport, College Park, and what I do remember is that cap rate, and it was 6.25. Why would you buy a multifamily apartment complex with a 6.25 cap rate near the airport when you can do the same thing, if not a little bit better, of a deal on Buford in Atlanta, where you have a more stable tenant, a better looking property, and a long-term hold strategy that just is more sustainable than, I don't know, having an arson live near the, I don't know, this is the major issue. So the other component of multifamily, and even if you own a lot of single family, you still have management, right? You still have to do that every single month. And talk to me a little bit about that, the management side of self-storage. How intensive is it? Is that something that I have to be worried about either as an operator or an investor in, say, a fund or some type of deal that Titan does?
Yeah, so the management factor is much easier in self-storage when it comes to just the active role, right? So let's say you're doing a self-storage facility on your own. When you look at the comparison to multifamily, let's say you have 1,000-unit building or 1,000-unit complex, you're going to need multiple managers, maybe a regional manager as well. And these guys are not cheap, right? These guys and gals they have salaries in the $60,000 to $100,000 a year range. With 1,000-unit self-storage facility, we can usually get away with a person and a half, maybe 2 full-time people. And these salaries are going to be closer to the $35,000 to $50,000 a year range, plus maybe some bonuses if you want to incentivize them. When you look at the smaller facilities, you can almost completely automate those. We actually have a few properties in our portfolio that are 100% unmanned. They have a rental kiosk. People can rent and buy insurance online or through their phone. The unit will be unlocked for them when they show up, and then they just take care of it. And it's, again, because it's not a habitation-based real estate investment, usually your tenants, for the most part, you're going to see them twice, when they move in and then when they move out. They very rarely will come, multiple times a week or multiple times a month like you would with a multifamily property. And that's one of the reasons we really like it is, I'm not trying to be the richest guy out there. I'm just trying to build a lifestyle-based business. And I think a lot of listeners are trying to do the same thing. And so that's what really attracted me to self-storage was, I spend maybe 4 to 10 hours a week managing our entire portfolio.
Nice. So, and by lifestyle business, I just want to make sure like we're both clear on what a lifestyle business means. That means, that means having like a dual level garage where the Ferrari is parked underneath the actual garage, and then you have an elevator like thing that brings the Ferrari up to the level and you can drive it out, and then park it next to the Bugatti that you have. Right? Like that's
close.
Kind of
What I recently did was I went to Thailand for a month, turned off my phone, didn't check my email once. And when I came back, my business was doing better than when I left. So that's kind of what I mean by lifestyle based.
I know I'm poking fun at you a little bit, but and it's true, right? Because there are a lot of folks that still have that image of entrepreneurship or lifestyle, or as an investor, like I'm going to have all the cars and the That is so beyond
Right.
superficial. Like, none of that matters.
I
What
want my
matters,
time is what's important to me.
exactly. And you hit the nail on the head, man. I mean, we take a look at what business means. And it's not building a job that's what matters anymore. It's truly building a business. And a
Right.
lot of folks, and you see this every day, you see a lot of real estate investors or just small business entrepreneurs, they're building their life around their business and not their
Right.
business around their life. And that's a major problem for me.
Right.
And self storage is a solution to that because you get rid of all the management from what it sounds like. You get rid of the management, the headaches, and the hassle, and all of that. And it's also a really good hedge to any major negative economic downturn,
Right.
which I think makes sense. Evictions, you can pretty much goes away, right? That's inside of 30 days. I'm kind of looking at my notes and taking some notes. And you also talk about it being a fragmented market.
Yes.
What does that mean? Is it I don't get that in the self storage capacity.
Yeah. So the estimates are right now that there's roughly 52,000 to 60,000 self storage facilities in the nation. Now, that ownership of those, let's say 60,000 facilities, is broken down by the following: about 18% of those facilities are owned by the six largest REITs, the big publicly traded players. Uh, Another 9% are owned by the top 100 operators below those REITs,
Okay.
which I would fall into. And then that means that there's still 73% of all these facilities are owned by mom and pop operators, which means they own two or less facilities. This is usually a secondary source of income. They're not operating it like a real business. So there's a lot of opportunity to get into a facility at a very high cap rate day one, do a value add on top of that. It's not uncommon for our properties, once they become stabilized, to be performing at a 12 to a 16% cap rate internal.
Got it. So when you walk in, what's your cap?
Usually we're shooting for anything better than an 8.5. Right now, our portfolio average is a 9.7.
Got it. And the value add that you're going to do is what? Renovates, tech, maybe a little. What are some of those value add pieces that makes Titan special?
Yeah, we have a multiple tier system. So the very first thing, the physical value add is almost the last thing that we do. So the very first things that we do when we walk in is, number one, get a advertising and marketing plan in place, build a website. A lot of the facilities we're purchasing, they don't have any of these things at the moment, and they're missing all of this traffic. About 60%
Mm.
of your customer base are going to find you off of your cell phone, right off of here. And if you don't have a website, you're missing a huge potential. The second thing we do is we raise rents to market rate. Many times when we come into a facility, they're charging 20 to 30% below the competitors. The next thing we'll do is drop all the expenses. So when we get into facilities, usually the owner has owned them for 15, 20, 25 years. They have never contested the property taxes, so they're artificially high, and they've never shopped their insurance quotes. On top of that, they usually are employing too much manpower for what the facility actually needs. There's no point in having somebody work 40 hours a week if all they're doing is, sitting at a desk playing solitaire for 6 of those 8 hours a day, right? And then at that point, then we start actually putting in the management efficiencies. We bring in our management software. We'll upgrade the tech. At this point, now we're actually looking at physical improvements.
Yeah.
We'll put keypad entrance and exits, automated gates. We'll put rental kiosks on site so that someone doesn't even have to interact with the manager if they don't want to. And then after all of that is done, if there's additional land, we'll actually start building additional units and adding climate control.
Got it. So when you're looking at a deal, and we'll wrap up here in just about a minute and a half, but I want to get through this. When you're looking at a deal and you're looking at a deck and an investment opportunity, what are you specifically, like, what would stand out to Fernando and Titan Wealth Group and saying, hey, this is a deal versus this is not a good deal? What are those few characteristics that I can walk away with after watching this and say, okay, cool, like I feel a little smarter maybe doing this myself or getting in touch with Fernando at Titan Wealth Group to see what opportunities exist? What are those 4 or 5, or maybe 3 main kind of characteristics you guys look for?
Yeah. Number one is we look at the market, right? We want to make sure that the market is not saturated and there's room for growth. So the easiest way to do that without getting into the super complicated stuff is just call up the local competitor facilities and ask, what percent occupancy are you? Are you at or above 90% occupancy? If the answer is yes, that means that there's probably some pent up demand in that market. Number two, we look at the rent rolls and we just compare them to the competitors' websites and see, are we charging what the competitors are charging? If not, there's a spread, then that's day one value add. The day we walk into the facility as owners, we send out a letter to all the tenants saying we're bringing you from 70% of market rent to 95% of market rent effective in 60 days, right? So that's value add right on the table. And then the next thing we look at is just the manager. Is the manager stealing? Are they, not doing what they're supposed to? Are they not driving sales? That's always an opportunity to put someone that's a high performer in that seat, drop the amount of billable hours, and still increase revenue.
Yeah, got it. So when you're looking at these competitors and you're looking at driving that, essentially you're forcing that appreciation, forcing that value from, I don't know, $100 a month to $150 a month, say.
Sure.
That sounds like it's a fairly, that just sounds very, very logical. And it sounds like it's less complicated than like a multifamily deal.
Yeah. And then to point some corollaries to the multifamily market, what happens if you increase the rent on your multifamily tenants by 20%? Most likely they're going to be moving out. But self-storage has a very high, what I call sticky factor. So if I were to increase the rent on a unit by 20%, that may only account for, say, a $20 to $30 per month increase. They're not going to go and rent a $500 rental moving truck, spend 2 to 3 days of their time moving out of this unit, moving to another unit. Usually they'll just let it ride. Yeah, usually they'll just let it ride.
That's smart. Got it. So any additional gold nuggets before we kind of wrap up? And then, of course, I want to get your contact information if I have any questions or if any of the viewers have any questions. What's maybe one gold nugget for new self-storage investors? Because I'm sure, you're thinking about this and you're watching and you're like, well, okay, I see the value. I see where Fernando's going and I get it. And I'm kind of looking and I'm maybe in between different strategies right now. What should I be considering with self-storage?
Yeah. Finding these facilities is really easy. They're everywhere. And up until probably this show, you probably haven't seen them, but now that it's in the forefront of your mind, you'll be driving to work or driving to your office and you'll see self-storage facility there and another one there and another one there. And the easiest thing to do is just to stop in or just call the number on the sign and say, hey, I was wondering if I can talk to the owner about potentially selling. It's that easy to get into a conversation with these owners. And a lot of them right now is the time that they're looking to sell. Right. A large majority of these owners built or bought these facilities between the late 80s and the late 90s, and they're looking to retire. And the best part is a lot of them don't want to take these massive capital gains and depreciation recapture tax costs. So they're willing to sell or finance for you.
Yep, you took the words right out of my mouth. And then in terms of occupancy, you mentioned if you're doing research in an area and it's a 90% occupancy, that means that it might be a little saturated, that market might be a little saturated, but what's the floor? When do you know there's not enough demand and don't buy in this area? If it's at 40% occupancy, 50%?
Right. So for us, we consider 90% occupancy to be equilibrium, because if you have above 90% occupancy at your facilities, you're not charging high enough rent. And if you're below that, there can be a whole slew of factors. So when we look at competitors and all of a sudden we see a competitor at 60%, another one at 70%, another one at 50%, that's not going to be a very good market for us to buy and acquire existing or build new.
Got it. Smart. So if I drive down the street today and I'm like, all right, Fernando, I got this guy, or I got this gal, she wants to sell, and their occupancy is 37.5%, that means that there's probably some challenges there that I need to address.
Yeah, and I mean, I wouldn't say use that as a blanket, right?
Right.
If they're at 37% and you're looking to buy their facility, but all the competitors at 90%, that means that there's probably a good opportunity for you to buy that facility, turn it around, and then maybe flip it in 18 months and make 2 or 3 times your cash back.
I like this. Now I'm going to start looking at self-storage, and then I'll just call you. That's exactly what I'm going to do. I'm like, hey, I've got this. I don't know what to do. Fernando, take it home for me. So that's going to be
We've
good.
actually done a few of those in the last couple of months. Other investors that have heard me on different podcasts,
Yeah.
maybe single family or multifamily, they've bought properties to us and say, hey, Fernando, I don't know how to do anything on this. Can you help me? I say, sure. And we ended up partnering on them. We just closed on 2 of them in the last probably 60 days from investors that I never saw the deal. They brought it to me. We did all the underwriting. We lined up the debt and the equity, and then we put the management in place.
Awesome. Fernando, this was fun. I learned a lot. I know the viewers learned a lot. Thank you so much. What's the best way to get in touch with you?
Yeah. So if you find me on social media, my social media handle is @thestorage_stud. So you can check that out. You can also go to our website, thestorage_stud.com, or you can go to our investment website, which is titanwealthgroup.com.
Awesome. And you're talking about like you, the stud, not like the stud that I'd find on the wall.
Yeah.
Okay. I'm just making sure that there's a very specific delineation there. All good, man. Dude, this is a lot of fun. Thanks a lot. I certainly appreciate it. And we'll have you back on soon.
I appreciate your time.
You got it. Thanks a lot. Think Realty Nation. The next segment is brought to you by Norada Real Estate Investments, your premier source for cash flow investment property. Visit www.turnkeyrealestateinvestments.com. Survey says 84%. I've always wanted to say that. Survey says 84% of folks believe that renting is more affordable than owning. And this is a survey from Freddie Mac. Reveals that affordability issues remain a top concern for those who are looking to rent or purchase a home. It's very, very interesting. And I alluded to this at the beginning of the show, which was about 1.5 years or 2 years ago when we had the Think Realty radio show. I was speaking with multiple guests on the show about how the idea of owning the American dream has now changed to renting the American dream. And I'm interested to kind of see some more mathematics behind this. And what I'd like to do is do some math and offer the spreadsheet. Whomever wants to get that spreadsheet, I've done some analysis on this already. So if you want the spreadsheet of why renting is potentially better than owning, just get in touch with me on social at Abi Golhar. Happy to provide that for you. But it's very, very, very interesting. So Freddie Mac, let's see here. All right. 42% of renters surveyed are currently cost burdened, means they're paying more than 1/3 of their income for rent, which is up 8 points from April of 2019. And this is compared only with 24% of owners paying the same amount, and a number that has not changed in like the last couple of years. 18% of renters are not interested in ever purchasing a home, which is up 4 percentage points from August of 2017, which I find kind of interesting. Right? They never want to own a home. So, maybe something to think about. 67% of renters have made spending changes or have moved to afford their housing monthly payment, up 5 points from April 2019. And among those who live in rural areas, 70% made changes to afford their monthly payment. And 82% of renters in the essential workforce also had to adjust, which is up 76% from April in 2019. So, or in April of 2019. So a lot of changes there. Good, bad, ugly? What do you think? You tell me. If you want to get in touch, at Abi Golhar, anywhere on social, LinkedIn and Instagram are my 2 favorite social media channels right now. And if you have any other questions about anything you've learned about about self-storage or some of these statistics, certainly get in touch. We're here to help at Think Realty. This podcast is brought to you by Aaron B. Chapman. .com, where you can bypass all the overcomplications of the common suit and tie mortgage guy and connect with Aaron Chapman and his team of real estate investment finance experts at Security National Mortgage. No fluff, no complicated industry speak, just brutally direct action. Visit aaronbchapman.com today for more information. That's aaronbchapman.com. Think Realty Nation, that's a wrap. Again, you got questions about this. It's about you. It's about your strategy and how you're going to take it forward and really grow your portfolio. At the end of the day, your lifestyle, giving back, and just being able to sleep well at night is what matters. Until next time, happy investing.